Hey guys, Dave Keller here with Market Misbehavior. A lot of technical analysis comes down to identifying and defining trends. One of the great ways to define trends is using moving averages, and one of the most important breadth indicators to watch right now is based on where stocks are relative to their moving averages. So today we'll talk about the most important breadth indicator to watch today. So moving averages are an important part of the technical toolkit. It's a way of getting away from the noise of the day-to-day movements, or what I call the flickering ticks of the market. It's more expanding out that trend analysis, taking the noise out, just looking at the overall trajectory. We'll look at a chart of Alphabet. We'll talk about what price relative to moving averages really means. Then we'll focus in on one breadth indicator driven off moving averages that I think is an important one to watch here in January into February of 2023. We'll also talk about Netflix and why it's a great example of the types of stocks that could indicate further upside to be had for stocks. Let's look at the charts here. You can see the chart of Alphabet really is in two halves. If you look at 2021, you have a classic uptrend, stock making new highs and new lows fairly consistently. For the most part, it's above two upward sloping moving averages. That is a classic bull market phase. Look at how things started to change here in the fourth quarter of 2021, the first quarter of 2022. We started to fail to hold the 50-day moving average. We eventually failed to hold the 200-day moving average. And eventually, we had the dreaded death cross where the 50-day crosses down through the 200-day moving average. From that point on, look at how the chart literally rotated from uptrend to downtrend. Instead of making higher highs, we make lower highs. Instead of making higher lows, we make lower lows. Instead of being above two upward sloping moving averages, we're below two downward sloping moving averages. It's literally the reverse. So price relative to moving averages is an important way to just measure overall trend. And if you think about it, this is just looking at one stock like Alphabet. Using breadth analysis, we can look at hundreds, if not thousands of stocks and make that comparison. Where is the price relative to key moving averages? And it gives you a chart kind of like this one we're looking at here. Just to give you a sense of what we're at, the S&P 500 is at the top in a closing basis going back for the last 2 years. I have the 50 and 200-day moving averages plotted on the S&P's chart at the top. The next panel down is the percent of stocks inside the S&P 500, those 500 names. How many of them, or what percent of them, are above their own 200-day moving average? You can see it's currently here at 62% in sort of mid-April. Mid-January 2023. Be patient with the calendar, Keller. Then in the bottom series, we have the percent of stocks above their 50-day moving average. You can see that's currently around 63%. Now, you can see these pink horizontal lines that I have up on both of these indicators, particularly with the percent of stocks above their 200-day. I was taught, one of my early mentors told me, nothing good happens below the 200-day moving average. That was a way of saying, in general, you want to own stuff that's above its 200-day, and you want to not own stuff that's below its 200-day, because things above their 200-day moving average are in an uptrend. Those are the things you probably want to own. Anything below the 200-day, you probably don't want to own. That's completely generalizing the practice, but you get the idea. So the 50% line I found to be an important one, because if this indicator is above 50%, that means more than half of stocks are in an uptrend, using that basic definition of are they above their own 200-day moving average. When we've been above the 50% line for so long, then we start to break below it, which we did in the first quarter of 2022. That tells you things are maybe different, what I would call a change of character in the chart. And sure enough, this was early days in what happened to be a fairly painful year for risk assets. Stocks like Alphabet and Netflix and Meta and many, many others in established downtrends in the first half of the year at least. At the bottom, we have the percent of stocks above the 50-day moving average, and that is a little noisier, right? So you get a lot more movement, because even if things are in a downtrend, you can see the S&P is in a downtrend for pretty much all of 2022, but you can see there are periods when it bounces above its 50-day moving average. That shows short-term strength, even though the long-term trend is still negative. So the indicator getting above 50% on the bottom tells you this is a bear market rally at least. At best, it could be the beginning of something further, but you'd want to see the percent above their 200-day also get above 50%. That's what we didn't see in sort of the second quarter of 2022. Really didn't see it in August of last year when the S&P tested its own 200-day moving average, but more than 50% of the S&P members remained below. Compare that to what we saw in November. when we think about what could be different this time around, the breadth conditions have been much more attractive. Look at the rally off the June low and how we got up to around 90% of stocks above their 50-day, but most stocks remain below their 200-day moving average, just like the S&P did. Look at how that's different in October through December when you saw the S&P testing its 200-day, but over half of the S&P now above their 200-day. It got up to around 65% in late November around Thanksgiving. And of course, at the bottom, over about around 90%. So same percent of stocks making it above their 50-day, but many more got above their 200-day, and notably above 50%. Here's where it gets really interesting. Look what happened in December when the S&P pulled back. A lot of individual names pulled back after having that nice run, 6 or 8 week run off of the October lows. Price pulled back a little bit. The S&P pulled back to 3,800, but both of these indicators basically pulled back to 50%, but didn't get much lower. That tells you that you really didn't see the retrenchment, sort of that move back to the new lows. You saw things that had rallied off the lows, but sort of held their ground and made a higher low in December. That sets us up for January, where we've seen a lot of renewed strength, particularly this week and last week coming off of the out of the new year. So overall, as long as these indicators remain above 50%, I would argue the breadth conditions using this indicator remain fairly constructive. Now, why is this such an important chart to watch? Two things I would point out for you. Number one, does the percent above their 200-day remain above 50%, particularly if we start to see the market roll over? If the S&P would fail to really get above 4,000 or 4,100 and test 3,800 again, I'd watch to see if this indicator can hold 50%, because if so, that might just tell you it's another pullback within a larger uptrend, within a broader appreciation in equity assets. If we would break 50%, that would tell you something's different. Not only, we had a different read from mid-November to wherever that would be, but if we break below 50%, that tells you that a lot of individual names are now failing to hold their 200-day. Stocks that had broken above are now failing to hold them on the as they retest them from above. That would be a fairly bearish sign. The other indicator would be this one at the bottom. How many stocks are able to hold their 50-day moving average? Because the first thing that would most likely happen is you'd see a break of the 50% line at the bottom, because stocks tend to break their 50-day first, and then they would fail to hold their 200-day moving average if they're already in an uptrend. These two indicators break below that 50% line. That would tell me to be incredibly skeptical about market upside. And while there might be some, a limited number of names still working, just like energy did in the first half of 2022, still on a broader basis, it's not a broad advance as much as you'd want. I'll finish with the chart of Netflix. Had a really good week as we're recording this here on Friday, January 20th, up almost 8.5% today, and moved to a new swing high, getting above 340, which is a pretty impressive follow through. But what I like to show here is this rotation from the stock being below two downward sloping moving averages in the first quarter of 2022. Look how it made a new low in May, but has not touched that level yet. We tested it a couple times, got above the 50-day moving average in July, a couple retests, but no real trading below it too much. We see we broke above the 200-day moving average in October, and now we're above two moving averages. The 50-day moving average still sloping higher. The 200-day is still kind of heading its way down, but trying to hook a little bit higher. So Netflix is maybe the example of the type of chart we would need to see more and more of to be convinced of a further upside to be had, generally speaking, for equities. The markets move higher when the stocks that comprise those market averages are able to move higher as well. The more charts like Netflix we see, the more bullish it could become. However, it all comes back to that breadth indicator, the percent above their 50 and 200-day moving averages. Watch those going forward, particularly that 50% level, which I think could be incredibly important. This sort of thinking about investor decision-making, technical analysis, and behavioral finance is of interest to you. I hope you will subscribe to our channel. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. Do you think these indicators remain above 50%? Do you buy into the bullish argument for S&P 500 and the NASDAQ? And why? Let me know in the comments below. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. See you again soon.